Your money-making broadcast starts now. Evening markets closed with a continuation of the semiconductor surge that has defined the past week, but today's session brought a major new catalyst. The United Arab Emirates shocked global energy markets by announcing its exit from OPEC. The S&P 500 finished higher as tech and energy stocks powered the index, while the Nasdaq 100 extended its rally on continued semiconductor momentum. Energy stocks surged as crude oil prices spiked on the UAE announcement. For Canadian investors, this creates a fascinating dual narrative. The TSX energy-heavy composition stands to benefit from higher oil prices, at the same time as Canadian consumers face record-low sentiment over surging gasoline costs. Gold and silver declined, putting pressure on TSX mining names. Consumer sentiment hit a record low, dragged down overwhelmingly by gas price anxiety. President Trump heads to China for a summit this week, adding a trade policy wildcard. Let's break down every angle of today's complex session. Let's start with the semiconductor supercycle because it remains the dominant market narrative. Micron technology surged another 9.34% today, closing at $707.04. The weekly gain now stands at roughly 38%. The market is pricing in a multi-year memory chip boom driven by AI data centers that require massive amounts of high-bandwidth memory. Advanced micro devices climbed 6.6% to $435.26, as its AI GPU roadmap continues to attract institutional money. Qualcomm rose 6.5% to $215.74, benefiting from smartphone chip demand and growing automotive semiconductor exposure. Intel gained 6.1% to $116.30, adding to its massive two-day rally from last week. Cisco Systems rose 3.8% to $95.67, reflecting the downstream beneficiaries of the AI build-out. The Philadelphia Semiconductor Index is up over 10% in the past week alone. This is not a speculative bubble. This is a structural repricing driven by real demand from hyperscale data center operators building out AI infrastructure at unprecedented scale. The legendary growth stock investor, Phil Fisher, would study this moment with intense focus. He would look past the daily price action to the underlying business transformations. His entire philosophy was built on identifying companies undergoing structural change that the market has not yet fully priced in. Intel's foundry pivot, AMD's data center dominance, and Micron's memory supercycle all fit that framework perfectly. He would be most interested in Intel here, because the turnaround story remains the least understood by the broader market. For Canadian investors, there is no direct TSX semiconductor exposure, but the ripple effects are significant. Canadian industrial automation suppliers, power infrastructure companies serving data centers, and networking hardware manufacturers all benefit indirectly from this multi-year capital expenditure cycle. Now let's turn to the biggest geopolitical story of the day. The United Arab Emirates has announced it is leaving OPEC. This is a seismic event for global energy markets. The UAE has been one of OPEC's most influential members for decades, and has frequently chafed against the production quotas set by Saudi Arabia. Its departure signals a fundamental fracturing of the cartel's ability to coordinate global oil supply. Crude oil prices surged on the news, driving energy stocks sharply higher. Occidental Petroleum gained 4% to $55.14. For Canada, the world's fourth-largest oil producer, this is profoundly important. Higher oil prices directly benefit the Canadian energy sector. Suncor Energy and Enbridge, two TSX heavyweights, stand to gain from the rising price environment. Enbridge operates the pipelines that move Canadian oil to global markets, and higher crude prices mean stronger throughput revenues. The legendary Fidelity Fund manager Peter Lynch would appreciate Enbridge. He would look at the pipeline network as something he fundamentally understands. Lynch's famous philosophy was to invest in what you know. Canadians know energy. Canada is an energy superpower. The pipeline infrastructure that connects Alberta's oil sands to export terminals is essential and irreplaceable. He would point out that when geopolitical instability threatens supply from OPEC nations, Canada's position as a stable, democratic, and reliable energy supplier becomes more valuable. For Canadian investors, Enbridge offers a way to play the oil price story with a strong dividend yield and defensive infrastructure characteristics. However, there is a human cost to rising energy prices. Consumer sentiment hit a record low this month, driven overwhelmingly by surging gasoline prices. For Canadian drivers, the situation is even more acute given Canada's colder climate and greater distances between cities. Every dollar increase at the pump is a tax on Canadian households. The Bank of Canada will be watching this data closely. Higher energy prices are inflationary for the Canadian economy, complicating the central bank's path forward on interest rates. If inflation remains sticky, rates may stay higher for longer, impacting Canadian mortgage holders and real estate markets. On the trade and geopolitical front, President Trump has departed for China for a summit with President Xi Jinping. The markets hope for progress on tariff negotiations, but the backdrop is challenging. UK exports to the United States have already fallen 25% after the imposition of new tariffs. This is a warning sign for Canadian exports if trade tensions escalate further. Iran has rejected the latest peace plan, sending gold and silver prices lower as safe haven demand subsides. The precious metals decline puts pressure on TSX mining names. For Canadian investors, the geopolitical landscape is complex and demands a diversified approach. The China-US summit could determine the direction of global trade for the remainder of 2026. Now let's translate all of this into actionable stock picks for Canadian investors after today's close. These are names you can research in your TFSA, RRSP, or margin account through your Canadian brokerage. Prices are listed in US dollars with approximate Canadian dollar conversions for practical reference. First pick, Cisco Systems, trading at $95.67, or approximately $130 Canadian dollars. Cisco is the plumbing of the internet. Every major Canadian enterprise, every big bank, every telecom company uses Cisco networking equipment. The AI data center build-out requires massive upgrades to switching and routing infrastructure, and Cisco is the default supplier. He would approach Cisco as a company he understands. He would look at the product, the customer base, the competitive moat, and the long-term demand driver. Cisco checks every box. The dividend offers about a 2.7% yield, the balance sheet is pristine with net cash, and the AI networking tailwind is just getting started. This is a high-quality business at a reasonable valuation that benefits from the structural trend in AI infrastructure spending. For Canadian investors wanting balanced AI exposure without the volatility of pure-play tech, Cisco at $95 is an attractive entry point. Second pick, Pfizer at $25.81, or approximately $35 Canadian dollars. This is the value play of the day for Canadian income investors. Benjamin Graham, the father of modern value investing, would look at Pfizer and see the classic margin of safety. He would note that the stock trades at roughly 10 times forward earnings. The dividend yield is over 6%. The company is cutting costs aggressively, buying back shares, and advancing a pipeline of drugs that will generate reliable revenue for decades. The market has thrown it out with the bathwater, but Pfizer is not a broken company. It is a blue-chip pharmaceutical giant trading at distressed prices. He would remind us that the best time to buy quality companies is when nobody wants them. For Canadian investors who want defensive income with upside optionality from the pipeline, Pfizer at $25 is a compelling value proposition. Third pick, Intel, at $116.30, or approximately $158 Canadian dollars. This is the turnaround story of the year. Intel has undergone a massive restructuring under new leadership, pivoting from a company that designs and manufactures its own chips to a foundry that manufactures chips for other companies. The market is beginning to recognize this transformation, but the full extent is not yet priced in. He would study Intel carefully. He would want to understand the foundry strategy, the customer pipeline, the manufacturing technology roadmap, and the long-term margin profile. He believed the most profitable investments come from companies undergoing genuine business transformation that the market has not yet fully understood. Intel fits this description perfectly. The semiconductor supercycle provides the wind at Intel's back, but the foundry pivot is the structural story that could define the company for the next decade. For Canadian investors willing to look past the recent volatility, Intel represents a high-conviction growth turnaround play. Fourth pick, Roku, at $127.11, or approximately $173 Canadian dollars. This is the highest risk, highest reward pick in today's lineup. Cathie Wood, the world's leading innovation-focused fund manager, would look at Roku as a platform company riding the secular shift from linear television to streaming. Roku is not a hardware company. It is a streaming platform that generates revenue through advertising, content distribution, and subscription services. The shift from cable television to streaming is one of the most powerful secular trends in media, and Roku's operating system is embedded in millions of smart TVs across North America, including across Canada. She would argue that the total addressable market for streaming advertising is enormous, and that Roku is uniquely positioned to capture a significant share. For Canadian investors with higher risk tolerance, Roku offers exposure to the future of television at a valuation that does not yet reflect the platform's long-term growth potential. Let me leave you with one final thought on Canada's energy opportunity. As the UAE leaves OPEC and crude prices find a new floor, TSX-listed energy infrastructure names like Enbridge and Suncor become increasingly attractive to Canadian investors. These are companies that benefit directly from the structural shift in global energy supply. Canada is an energy superpower with some of the most responsibly produced oil in the world, and the current geopolitical environment only strengthens that position. Diversify your portfolio, stay focused on quality businesses with durable competitive advantages, and remember that the best investment opportunities often come from understanding structural trends that the broader market is underestimating. This has been your May 11th Market Close Recap. I'm Chloe. See you at 7 a.m. Eastern for shorts, and stay tuned for more Toronto market insights. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.